Running an assisted living facility means balancing care, compliance, and constant expenses. But when tax season comes, most owners realize the IRS took more than it should have. I am Larry Davis, founder of Tax Help. We help business owners to clean up their book, reduce their tax bills, and finally get control of their finances. Not because they did something wrong, but because of silent traps hiding in plain sight. From the way you track expenses to how your business is structured, small oversights quietly add up to thousands lost every year. I've seen owners who thought their taxes were fine until we found the leaks. Missed depreciation, disorganized books, unclaimed credits, and overpaid payroll taxes. These are the invisible mistakes draining your profits. You didn't open your facility to become an accountant, but understanding these traps can mean the difference between surviving and thriving. In this series, we'll uncover the silent tax traps in assisted living and healthcare owners and show you how to finally take control of your finances before the IRS takes more than it should. Mistake number 1, the cost of commingled accounts. In assisted living, your facility operates like a mini healthcare system, structured, licensed, and accountable. Yet many owners blur the line between personal and business finances, unknowingly creating tax chaos. I've seen owners swipe the same card for gas, groceries, and resident care expenses, only to discover that the IRS disallowed a large portion of their deductions. One 12-bed facility owner lost over $10,000 in write-offs simply because personal and business payments came from one account. Once we set up separate business banking, connected digital expense tracking, and scheduled weekly reconciliations, everything changed. Her deductions increased, her reports became cleaner, and she finally understood where her money was going. Treating your finances with the same professionalism as resident care isn't optional, it's essential. The moment your books reflect discipline, your taxes start rewarding you for it. Mistake number 2, the generic accountant trap. Most assisted living facilities work with accountants who handle general small businesses, restaurants, retail, construction, but not healthcare operations, and that's where owners lose big. Healthcare carries unique deductions: staff medical training, compliance upgrades, licensing fees, and therapy tools. A facility I reviewed had been using a general CPA for years, unaware that thousands in eligible deductions were being ignored. When they switched to a healthcare specialized accountant who understood patient care costs and HIPPA compliance, they immediately uncovered $18,000 in missed deductions. The change wasn't about paying less tax, it was about documenting expenses correctly and aligning financial reports with healthcare regulations. When your accountant speaks the same language as your industry, you don't have to explain your operations. They already know where the tax savings live. Mistake number 3, the miscellaneous money leak. If there's one word that silently kills deductions, it's miscellaneous. Assisted living owners often dump expenses into one vague category, mixing staff meals, cleaning supplies, PPE, and maintenance all together. The IRS sees that as unsubstantiated spending, and that's where legitimate deductions disappear. I worked with a facility that had nearly $75,000 in miscellaneous expenses rejected because they couldn't clearly explain what those costs were for. We rebuilt their chart of accounts with categories specific to assisted living, resident care, medical supplies, operations, transportation, training, and admin. Once we did, their deductions increased by 23% and financial clarity followed. The key is to name every dollar before it leaves your account. Organized records aren't just tidy. They tell a financial story that makes sense to the IRS, to your CPA, and to you. Mistake number 4, payroll pitfalls in care. Payroll is the heartbeat of every assisted living operation, but it's also one of the most common areas for costly mistakes. Many facilities misclassify caregivers or nurses as independent contractors. Not realizing it leads to double taxation and compliance risks. I helped one 15-bed home that was unknowingly overpaying $9,000 a year in payroll taxes because of incorrect classifications. We restructured their payroll to match IRS standards, added job-specific codes for each staff role, and implemented quarterly payroll reviews. The impact was immediate: cleaner reports, fewer penalties, and a stronger compliance record. Payroll isn't just about paying your people, it's about protecting your profit. When your system matches your structure, you gain both control and credibility in the eyes of regulators. Mistake number 5, entity errors. Most assisted living owners start small, often as sole proprietors or single-member LLC, but as their operations grow, their entity structure stays the same. That's a silent trap. A 10-bed residential care home I worked with was still filing as a sole proprietorship, paying full self-employment tax even after hiring a full team. By restructuring into an S-Corp, they saved 28% on annual taxes. Beyond tax savings, it created separation between owner income and business profit, adding a layer of legal and financial protection. Every facility reaches a point where it needs to grow into a smarter structure. When your entity reflects your scale, you don't just pay less, you build a business that's sustainable, saleable, and respected by lenders and the IRS alike. Mistake number 6, ignoring depreciation value. Every bed, wheelchair, van, or renovation inside your facility represents real value, and depreciation lets you reclaim part of that investment. But most assisted living owners don't track it. I reviewed a facility that spent $120,000 on renovations and new equipment, yet hadn't claimed a single dollar in depreciation over 3 years. That oversight alone cost them $40,000 in lost deductions. Once we built an asset register, tagged every improvement with its purchase date, and applied the right depreciation schedules, their taxable income dropped instantly. Depreciation isn't about manipulating numbers, it's about recognizing the cost of keeping your care environment running. When you document every upgrade, your tax return starts reflecting the true cost of operating a quality facility. Mistake number 7, the tax season panic. Every March, assisted living owners dig through boxes of receipts, praying their numbers add up. That's not a tax strategy, that's survival mode. I worked with a 20-bed facility that owed thousands in unexpected taxes each year simply because they only reviewed finances once annually. We implemented quarterly check-ins, adjusted estimated payments, and used a rolling 12-month forecast tied to occupancy rates. Within 6 months, they built a reserve fund and stopped borrowing to cover taxes. The owner told me it was the first time she felt calm in April. That's what proactive planning does. It turns tax season from chaos into confidence. When you manage taxes like you manage patient care, consistently and with foresight, you stay in control. Mistake number 8, ignoring owner benefits. In healthcare, owners often focus so hard on staff that they forget themselves. But the tax code rewards owners who structure their compensation wisely. A facility owner earning $180,000 was paying heavy taxes until we redirected a portion of her income into a SEP IRA and a defined benefit plan. Not only did her future retirement balance grow, but her taxable income dropped by $9,000 that year alone. This wasn't a complex change. It was about treating her role with the same intentional planning she gives her residents. Your salary, retirement, and benefits are all part of the same financial ecosystem. When you prioritize your own financial health, you protect your business's longevity and stability too. Mistake number 9, messy record keeping. Poor record keeping doesn't just cost deductions, it costs peace of mind. Assisted living owners deal with endless receipts, payroll reports, and invoices. When those documents live in drawers or paper folders, audit risks skyrocket. A facility I worked with digitized everything, scanning receipts daily and syncing them to cloud-based bookkeeping software. Within 3 months, their accuracy rate jumped to 98%, and tax prep time was cut in half. Clean records build confidence, not just for the IRS, but for lenders, investors, and staff. When your documentation is organized, you make decisions faster, respond to audits calmly, and keep your focus where it belongs, on quality care, not accounting chaos. Mistake number 10, missed tax credits. The healthcare field qualifies for more tax credits than almost any other industry, yet few owners take advantage. I met an assisted living operator who invested in energy-efficient lighting, new HVAC systems, and staff training, unaware those upgrades qualified for over $12,000 in federal and state credits. After reviewing their operations, we identified additional savings through the Work Opportunity Tax Credit for hiring long-term unemployed caregivers. These programs exist to support businesses like yours, but they only help if you claim them. Make it a yearly habit to review potential credits and update your CPA on operational changes. Every improvement in your facility could also improve your bottom line. You've already earned these benefits. Don't leave them unclaimed. Every assisted living owner starts with a mission to provide quality care. But without a financial system that supports that mission, even great operators struggle. These 10 silent traps, from mixed accounts to missed credits, aren't isolated problems. They're symptoms of disorganization and reactive planning. Once you create structure in your finances, everything shifts. Your reports make sense. Your tax liability shrinks. Your stress disappears. You become the kind of owner who runs a facility with precision, not panic. The IRS rewards organization, not effort, and every dollar you save is another resource to improve care, staffing, and your future stability. You built your business to care for others. Now it's time to care for your numbers too. Follow for more and stop overpaying the IRS for your hard work. If you're an assisted living facility or a healthcare business owner overwhelmed by tax confusion or financial chaos in your business, subscribe right now. Every week I share real strategies to legally help you reduce what you owe. Also, we'll send you our 10 tax strategies for assisted living and healthcare businesses to reduce their tax bill just for liking this video.